TechTalk Tuesday. I'm your host, Carla, and with me today is my fellow co-host and CMT, David Blake. It's Monday, March 18th, 2024, and we have some activity to talk about that happened in the stock market last week, along with some interesting things to look out going forward. We do it mostly from a technical perspective. David, I hope you had a great weekend. How are you doing today?
I'm doing well, Carla. Thank you.
Great. Well, let's get started by taking a look at last week's market activity.
Okay, we had a little bit of a volatile week again last week, but surprisingly, by the end of the week, major averages were just modestly lower. They kind of came back to the center line. The investors pretty much shrugged off data that pointed to inflation being stickier than hoped for last week. We had of course, the week before we had we had the CPI and the PPI, which is the consumer and wholesale prices, both ticked a little bit higher for a second month in a row. And that's probably going to lead to the Federal Reserve pushing out rate cuts to the second half of the year. What's interesting is tomorrow, we start the March FOMC meeting. And then, of course, we'll get Fed Chair Jerome Powell's comments at his press conference. That begins, I believe, at 2:30 on Wednesday afternoon. And I know that a lot of investors were kind of looking for a more dovish comment, hoping that we might see a June hike. Now it's actually being pushed out to about July. But I kind of think that perhaps the committee is going to maybe be a little bit more hawkish after 2 months of inflation data ticking up a little bit. I think that he's going to pretty much kind of confirm that rates are going to stay higher for a little bit longer than what the market anticipates. If he becomes real hawkish, which I don't think he'll do. Doesn't want to send the market tumbling down, but I just think that they may surprise the real bullish investors out here, and we probably can get a little bit of a pullback towards the end of the week. Surprisingly, we were down this week for a second week in a row on the S&P 500 and the Nasdaq, and believe it or not, that's the longest losing streak since October. Dow was actually down for a third week, although it was only down like 7 points, something like that. So it wasn't much of anything. But anyway, when the CPI and PPI came out, we did see yields nudge higher. The rate of the 10-year Treasury clicked up to 4.31. The 2-year T-bill landed at 4.73. I still think that if we get a more hawkish Fed, you kind of want to keep an eye on that 4.5 to 4.60 resistance level on the 10-year Treasury. If it would crack above that, I think you'll probably see a little bit more intense of a sell-off going forward. But the one thing that they call it the Fed put, as long as they're continuing talking about rates coming down lower in the year, you're not going to have much of a sell-off at any time. I don't even think you'd see a 10% sell-off. I think maybe 5 or 6 or 7% would be about as much as you're going to get if they really get hawkish in here.
Which market sectors were the leaders and which ones were the laggards?
The last week we had on the week, energy prices were the strongest market group. That was followed by materials. They also outperformed, and both of them hit new record intraday highs during the week. On the equities last week were weakness in REITs. They were down about 2.88%. Then you also had a little bit more rotation out of the big cap tech into some more cyclical sectors, and that caused losses in consumer discretionary and technology sectors, and we'll kind of watch that. Now today you're seeing a big jump in technology and communication services, as we had a announcement this morning that Apple going to probably put Alphabet's Genesis AI in their iPhones, which was a big deal early. We'll have to see how the Department of Justice thinks about that. But it actually caused Alphabet, I think, to go up. Yeah, Alphabet's up 7% today on that, up almost $10. And it also helped Apple. Apple's up another almost 3% today. So that's really given those two sectors, the technology and communication services sector today, a big lift, bouncing off of that.
So is the technical condition of the market still positive then?
As far as the technical condition of the market goes, it's still positive. If you look at the charts, you're seeing, you look at the MACD, it's kind of going, it's neutral. It keeps crossing back and forth along the zero line on the histograms. And then momentum is measured by the 14-day RSI. It continues to slow. And if you pull up the chart of the S&P 500 or the Nasdaq or Dow even, you'll start to see this way off the October lows, kind of moving sideways right in here. And then again, that's because of this uptick in inflation that we're seeing here over the last 2 months. We'll kind of have to watch that. You still have quite a ways to go before the major averages actually even test key support levels. And the S&P 500, I said on Friday, closed the week 11.7% above its 200-day moving average, which means it's still overbought by some measures.
If the S&P 500 sees a pullback, what could that look like for the broader markets?
Which means we can have a 3 to 5% pullback without even really having a hiccup in the broader market. So we'll just kind of watch with that. I think that we'll see Wednesday probably some real volatility in the market. Again, you're going to have the more bears suggest that the Fed's getting hawkish now. We're going to they may push out to September or so on their rate hikes. Powell led the market to believe that they would be cutting 3 times in the second half. One of his last speeches. And we'll have to see how that plays out on Wednesday. I do think, though, that it's not supposed to be politically motivated. They always say it isn't, but you will see rate cuts coming in before at least by September to make the market look good for the Biden administration. That it always happens. Whoever the president is, whether it's Republican or Democrat, if they're going to get a rate cut, it's going to happen before the election.
How are the secondary indexes doing?
The secondary indexes underperformed last week. That's a little bit of something that you also want to be aware of. A lot of technicians look at the transports and the small cap Russell 2000 and the Philadelphia semiconductor as indexes that will lead the market higher and lower. We talked a little bit a week or so ago about NVIDIA's bearish engulfing candle pattern where it went up, spiked way up, and then at the end of the day, low. And the Philadelphia Semiconductor Index right now is off about 4% last week. It's off about 8%, 8.5% since that last Friday when NVIDIA had to spike up and the whole the SOX index also spiked up. So that's had an 8.5% correction since in a week. So that's something to consider. But things, I looked today and NVIDIA was up another $20 or something like that again. So it's bouncing back quickly. It's kind of hard. You don't really want to short these things when they're that volatile and they're having that much of turnarounds. And again, they're still a ways off from cracking any major support levels like the 50-day or anything like that.
Okay, and what about underlying breadth?
Okay, underlying breadth last week was mixed. Again, with the markets going sideways in here, NYSE advanced decline line, which we kind of look at as a leading indicator, it printed several new all-time highs last week, and then Thursday and Friday, I think it started to roll over. And when we talk about that, a lot of technicians like John Murphy and Martin Pring, they talk about that the NYSE AD line can it usually will top out or bottom out before the market makes a turn. Again, we're only 2 to 3 days off of all-time high on the NYSE, so that's not telling us that we're likely to see the bears take control anytime soon. You're still seeing a wide a lot of more advancing and declining issues. We also saw both the NYSE and NASDAQ register more new 52-week highs and lows, although we did see some traction in those numbers. One thing you can take a look at on the Market Edge homepage, we do the 3,500 or 3,800 stocks that we follow, a number of upgrades and downgrades. As you can see, like today's upgrades were only 89, downgrades were 70. At this point, you're not going to get a lot of upgrades because we're long a hell of a lot of stocks. So you're not going to see when you're starting a trend and the trend is picking up momentum, where all of a sudden you'll see like 150 upgrades, something like that. But you do in here want to start continually watch the downgrades. If they start to expand or pick up the pace a little bit, that means that more stocks are kind of running out of gas, and that's going to give you a little bit of a preemptive move here that you may want to start putting in some stops or selling some covered calls, that type of thing.
And for a shameless plug, that's something that we actually post if you follow us on Instagram, Facebook, and or our Twitter pages at Market Edge Pro. We actually post those each morning. So moving on to investor sentiment, how's that looking?
Then lastly, investor sentiment, it continues to be overly bullish. We did see more bullishness in the professionals. The National Association of Active Investment Managers Exposure Index, it actually jumped to 104.8% last week. That means the professionals and hedge funds right now are on margin. And that's also the most exposure to equities that they've had since November of 2021. What happened that month? That was when NASDAQ actually hit its all-time high before this last move. So that's something you want to watch out for. Also, you'll notice that the percentage of bullish and bearish investment advisors now show the bulls outnumber the bears more than 4-1. That's that these are getting to extreme levels that you want to, when they start getting like that, you got to take notice a little bit. We did see a little bit on the retail bulls. The American Association of Individual Investors dialed it back a little bit. Now, normally the bulls are at right around 37.5%, and we've been above that historical average now for 19 consecutive weeks with the retail clients. So their retail clients are still very bullish, but they did dial it back from about 51.7 back to 45.9. So they may be getting a little bit more nervous. Let's kind of watch that. FINRA, actually, I mentioned this. Actually, we showed that the January margin levels are still below where they were last summer. That's an indicator that we can watch when it starts to gets moving up too much. That means that everybody's, not only are they bullish and long, but they're margined out and they're leveraging their longs, and that's another indication that everybody that likes this market is probably already in. And that just, then you start thinking, okay, what's going to drive this market higher? So we'll kind of watch that. There's also a lot of cash still on the sidelines, which can still fuel stock prices, to at least go sideways to up a little bit that. But again, I just want to point out that we do see these levels like that. It does hoist up the red flag and makes you want to be a little bit more cautious. So as far as this week goes, I think today a lot of the action was centered around the Google and Apple announcement. That really pushed. They're overweighted, so it moved Nasdaq up about 1.5% on that. Dow Jones is up about 150 points. The S&P is up 50 points. It's up about 1%. So it looks healthy. Wait for Wednesday. Wednesday's going to be when all the action comes in, and we'll see how the market reacts. I have a feeling that you may start to see some people pull some money off to, if we get real high today or tomorrow, if we have another bounce. I would be a little bit cautious after 2 months of higher inflation data. I don't see how the Fed can come in and say, hey, June we could cut in June. The market still thinks July is going to be the first rate cut. Very possible. Still have a couple more months of data to get out from that, but look for the action all to take place on Wednesday, and we'll see how that, whether it's hawkish or dovish, and that should control probably the next couple of weeks of market action going forward with Powell's statement.
Okay, well, speaking of investor sentiment, we actually had a subscriber question for this week's episode. And by the way, if you would like to submit a question for any of our Tech Talk Tuesday episodes, feel free to send us an email at support@marketedge.com. And this question was regarding the VIX and how readings under 13 are regarded as bearish while those above 30 are bullish. So I realize that this is a trader's indicator and we track multiple sentiment indicators on Market Edge. David, can you give us a little more information about some of the sentiment indicators, including the VIX, and how we can best utilize them?
Okay. Yeah. The question dealt with, okay, the VIX is staying low here. We're getting down, sometimes it dips up below 13. Why is that? That suggests less fear in the market. It's why isn't that regarded as bullish as the VIX moves down? Why is it once it gets to a low point? Why is it all of a sudden bearish? And when it gets above 30, why is it bullish when it gets above 30? When that means that traders are getting really nervous about the market. And basically, the VIX stands for basically it's implied volatility in the index options. Okay, and when it starts to reach these extreme levels, it signals that it can signal that a rally or a sell off is kind of has run its course. Now, when it gets low, like where it gets into 12s or 13s, what that means is that traders are becoming complacent with as far as their how they feel about the market. And that means that they everything they're all bullish. They think everything's going great. That they want to be in the market and they feel good about it. And that drives down the volatility in the market. It makes the VIX makes the option trades less premium on there. But then on the other hand, when all of a sudden you see the VIX spike up above 35 or so when you have these big sell-off days, which in this case would probably be about a 1,000-point move or something like that, and the traders begin to go, oh, I got to get out of here. This thing's God knows how low the market's going to go. That's kind of like what Buffett used to say. You buy fear and you sell greed, and even these things are not. When they jump up like that, a lot of times on these tech talks, I've talked about the VIX. You want to watch that thing. Once we get up in the 20s and all of a sudden you get a sell off one day and it jumps up above 25, that's when you start getting your powder ready. And then if you see it jump up about 35, you probably want to start nibbling, because that means when it gets like that, that means that fund managers and a lot of active traders are jumping out and they want to get out, and that's an opportunity for you to start buying some of these stocks when they're oversold, and you don't have to jump in all the way, but if you start to add to some positions, that's usually a good a good a good way to go with this. Now, there's other ones that we have on the weekly market letter that you can also go along with the VIX. We follow several of these things, and when everybody gets a little bit too bullish, the numbers will go down to like a -5, -6, -7. We were at a -9 just a couple of weeks ago. And then when everybody gets too bearish, then the numbers will creep up to get into +4, +5, +6, which means that they're getting overly nervous about the market, and that means okay, we're probably getting a little bit closer to a bottom. Now, one of the ones that we just recently talked about was the bullish investment advisors. As you can see, that's 60.9. I think that was the highest April 2020. So we're getting so when you get with something that's the highest has been in 4 or 5 years, that's got to be a red flag. Because that means that all these guys are already invested in the market. As I said, the exposure index shows that they're all on margin. They only have so much money to put into the market, and if they're already in, what's going to fuel the market to go up higher? Now let's see, that number, the bullish investment advisors hit 61.6 January 1st of 2014, and that was a temporary top. Stocks sold off. So you want to kind of watch that. On the other side, I mean, look at this. You have bearish advisors. Only 14.5% of the advisors are bearish. That means that nobody's bearish. And that's the last time that happened was 6 years ago. Was, let's see, 2018. These are numbers that you're getting to the point where they are at extremes, and when these sentiment indicators, they move up and down weekly, but when you start to see these things coming in like this, that really is a sign for you to start looking at everybody. Everybody's getting too complacent. They love the market. They don't care what's happening, what's going on. They don't care about inflation. They don't care about the rates going up. They just want to be in this market. And that's something that when you get a couple of them, like what we're seeing now, reaching these extreme levels, you just kind of watch that. I had a little thing here from Martin Pring. He has a book out called Technical Analysis Explained, and he notes about some of these investor sentiments when they reach extremes. He says better informed market participants, such as insiders and stock exchange members, tend to act in a manner that's contrary to that of the majority by selling at market tops and buying at market bottoms. Now, this doesn't mean that the public's always wrong and professionals are always right, but at tops and bottoms of rallies and sell-offs, Pring talks about the opinions of these groups are usually in direct conflict of what the market is doing. In other words, these guys are doing this trading 24 hours a day, and they're selling when everybody's rushing into FOMO. I don't want to be left out. These guys are starting to sell their positions to the retail clients and the guys that are jumping in at that point. In the same way when the VIX gets up there 35 to 40, the insiders and all see the market action of this, and they're actually buying when everybody else is jumping out. Those are the guys that are buying the market, and they catch it at the bottom. So you watch this thing on the market ladder, and when you see these things reaching the extreme levels, that's an opportunity for you to go, well, we're too bullish. I may want to get out of here. And then also when you see these things reach extreme levels like the VIX, when it falls down here, but say around 12, 13, again, it's regarded as bearish just because everyone is too complacent about it. And if something all of a sudden catches them off guard, like right now, if we get the VIX down to say 13 and a half, and all of a sudden Powell comes out and says, if he comes out and says we may not lower rates until October, November, you're going to see the markets sell off, because even though they're all bullish on the market, they're too complacent. That'll be something that caught them off guard and will cause the volatility to really spike up. So keep an eye on these things. And again, when you get several of them that are getting to extreme levels, you're going to, it's a red flag that goes up. And if you want to watch them on a chart, you can go onto the home page, and then we have something called the Market Recap tab. There you go, Market at a Glance. You can actually see these on the charts. Go down to the bottom of the page there, Carla. Okay, you can see the advanced decline. Here's the new highs and new lows. Okay, they're coming along. Here's the bullish advisors. It just keeps going up. The market volatility, you can see it's been since that October low down there. You can't see it since November, where it got really low. It's been starting to get a little bit higher now, because I think with the rally after you've been up 16 out of 19 weeks. I think you're starting to a lot of traders are starting to go. This is a historic run. Matches the longest run that the S&P 500 has had since 1923 when it was created. So you look at these things, you look at the bearish advisors, you just go, wow, this thing's really, really low. It's gone down for the last, straight down for the last 6 months or 5 months. Then you start to put these together, and that just lets you know ahead of time that, okay, I need to get a little bit, I need to get a little bit more hesitant on this thing and start to rein it in. I don't want to see this market drop 20% and I'm still in it. As you can see there on the margin debt, even over there, I mean, we're back there in September of 21. You can see we're up there almost $1 billion on margin. Okay, we're only at around 700 million right now, so it's working its way up. We're almost back to where we were in July. So that's when you get up to those extreme levels, that's going to be where you start to see. And that September 21, the market that peaked right there when it hit a top. That's when the Nasdaq peaked right there, and that would probably be November of 21 where you're at right there. And that's it gets up like that. You're at an extreme level. Boom, the market sells off, and to see that stuff. That's just a lesson for you to lighten up. There's going to be a bull market somewhere, as Kramer likes to say, and that would be an opportunity for you to have a little bit of powder dry for when something does sell off. That's all I got, Carla.
All right. Well, that was definitely excellent information, David. We are almost running out of time, so I'm going to have to wrap it up. But thank you again for all the helpful information, David. And thank you to all of our listeners. Be sure to like and subscribe so that you don't miss any of our future episodes. Thank you again for listening, and we will catch you guys again next week.